Today, we're going to talk about a very important topic that is resonating to every Canadian these days. You probably would have heard in the news recent and in 2025 that a lot of Canadians are leaving Canada. When they leave Canada, are they doing everything right? Because in our practice, what we have seen, people are though excited to leave Canada, there are some opportunities. However, they get unexpected bill after 6 or 8 months by CRA that they owe thousands of dollars of tax. Today, we have in our studio who is someone is expert in this field for over 25 years. And let me take this opportunity to welcome him. Wakar, welcome to the studio. Today we're going to talk about all about leaving Canada, what should be every Canadian should be taking care of, and how can they make sure when they leave Canada, everything in terms of taxation and their affairs in Canada are well taken care of. So let me dive right in. Wakar, what is departure tax?
Well, departure tax is if somebody is leaving Canada and he was a tax resident of Canada, and now Canada treats that since you are leaving Canada, so you have sold everything in your possession or in your ownership. So that is basically departure tax. You have to file when you will leave Canada, and not exactly in the same year, obviously in the following year.
So you're saying if someone leaves Canada, they have to sell everything? Or what is this deemed sold or deemed selling in Canada?
I mean that in the eyes of law, basically, it is a deemed sale. So when somebody is leaving Canada, so there are few assets those are exempt from deemed sale, but the other assets which we will discuss later in our video. So mainly, in the eyes of law, it says that you have sold those assets. So basically, you have not sold on paper, but at the same time, you have sold for tax purposes. So that is called basically deemed disposition.
I'm still confused. So even if you have not sold anything, you did not receive any cash, but the government still thinks that you have sold everything, and there are some exception what you're saying, and you have to pay tax on it. I want you to please show some light on it.
Yeah, exactly. Basically, so CRA says that when you leave Canada, since you have lived over the years in Canada, so you might have bought some assets, maybe some non-registered investments, especially stocks, bonds, or maybe crypto. So they say that when you were a tax resident of Canada, you have bought this, and the capital gain is accumulated during the time of your tax residency in Canada. So they want their share at the time of you are leaving Canada. So that is basically says that since you are leaving now, you have to pay us based on the capital accumulation happened during the year of your ownership of that asset, as well as when obviously you are a tax resident of Canada. So this is basically called like a deemed disposition. And even though you have not sold and you have not received any cash, so you have to pay. So the thought behind CRA is, since you are leaving, so we want our fair share, so just pay us now, because it will be really hard to track the liquid assets, especially as I said, that non-registered assets like stock, bonds, to go after you and ask you to pay the tax when you will actually sell. So they ask you to pay now when you will leaving Canada, and this is how actually basic the departure tax is calculated.
Thanks. So how much is that? Do we pay 50%, 60%, 100% taxes? So there are lots of misconceptions. So I want some clarification. What is the tax we pay and how much it is?
That is same as your marginal, that if you are in a higher income bracket, so you will pay based on your marginal tax rate. It is not like you have to pay, suppose you have bought one stock for $100,000, and over the years the capital gain is accumulated, and now at the time of your departure, so the stocks is worth, a fair market value of the stock is suppose $300,000, you have a capital gain of $200,000. So first thing is that you will be taxed based on your marginal tax rate, and the other thing is, it is the rules are same for capital gain, inclusion rate. So suppose you have accumulated 200,000 of capital gain at the time of your departure, so the inclusion rate is 50%. That means that $100,000 is included in your tax return, and that $100,000 is taxed on your marginal tax rate. And suppose your marginal tax rate is 45%, so then that means that the $100,000 you will be taxed 45%, means you will pay $45,000. So this is a misconception. You pay a lot of tax. So obviously that would be a lot of tax in a way, because you have not sold anything, but you have to pay tax based on deemed sale. But the tax rate would be your marginal tax rate.
Oh, so I think it clarified my confusion too. So it's exactly the same as resident, that when we sell anything, it gets treated as capital gains, and 50% of the capital gain is not taxable as per today's rule, and 50% of capital gain is taxable, and whatever the taxable portion is, you pay your marginal taxes, right?
Exactly, you got it right.
Now, that's great. So that is not too daunting, but we'll clarify. So do we pay tax on everything we own, or there are some exceptions, Wakar?
No, as I said, that there are many misconceptions about many assets that people are very get very anxious. I would say when they will think of if they are leaving Canada, so they have to pay tax on their all of assets. No, it's not the case. So all of your registered assets like RRSP, RIF, and RESP, and supposed TFSA as well. So those are exempt from departure tax. You can keep those in your registered asset even if you are not living in Canada and you have departed from Canada, but you are not supposed to contribute towards those registered assets, and those are not subject to departure tax.
So you're saying that I can keep my principal residence, I can keep my TFSA, I can keep my RSPs, but I cannot further contribute in both registered account, and I do not have to pay any tax on it when I leave Canada?
Yes, that's correct. But for principal residence, so since you are leaving Canada, if you have a house here in Canada where you are living and using as a principal residence, you can keep that house, but that will be no more your principal residence. You can use as a rental property if you want to rent that basically real property, and you can use as a personal residence, but it would not be your principal residence anymore. But technically, yes, that you can claim the principal residence exemption to that point, the day you will leave Canada.
And what about my driver's license, my bank account, my credit cards? What happens to those when I leave Canada?
Those are considered like a secondary ties, and we encourage people to just cut as much as secondary ties you can, because primary ties are considered your family. So we are assuming in this video that you are taking your family with you, and those single people, so that means you are that basic situation is not applicable to you. But for driver's license, you can keep driver's license, but we still recommend, like, if you don't need the driver license, if you are living somewhere else, and Canada has exchange agreement of the driver's license. Suppose if you are living for Dubai, and Dubai has a conversion agreement for the driver's license, go and exchange your license there. But we encourage, do not have the health card wherever province you are living. So do not keep the health card and do not use it. In fact, seize that. And for credit card, you can use your credit card, because sometime you have some work or some fees to pay here in Canada, and the bank account which you will use that transfer your some of your money into Canadian bank, and maybe to pay the mortgage, or maybe to pay certain fees, maybe professional fees and other some expenses. And sometime you obviously you are leaving Canada. That doesn't mean that you are leaving your citizenship, so you are not supposed to come back. So when you will come back, at least visit Canada, so you can use those credit card and at least the bank to expense whatever expenses you have. And that's why, like, you can keep one bank account, one credit card, and do not have or do not keep your health card. Just seize that, and yeah, that's something you can keep that in that order.
So we can keep our bank account, credit card, but we need to severe ties with our health card. We need to
Yeah,
surrender that. And you
exactly.
also interestingly mentioned about ties, which I think a full episode is deserves on that topic. What is our primary ties and secondary ties? We're going to talk about that. And so, in your practice, Ogar, what sort of mistakes that you see the lot of Canadians do that when they leave Canada?
So first of all, they are not aware that they have to file the that tax. In our practice, so we always most of the time we see that people call us and they say that since they have left, so they are not supposed to file their taxes. So this is wrong. You have to file your taxes, and you have to report CRA. Okay, so through filing of that departure tax return, that you have left Canada, so that way they will know, and they will stop paying you any benefits in form of like GST, HST credits, or any other benefit like CCB and all. We also encourage the time you will leave Canada, so just maybe log into your CRA account and change your address. Once you become a resident of any other country where you are, you have, you have planned your future. That way, CRA will know, and if you have kids and you are receiving CCB, so they will stop paying you CCB. Otherwise, the other option is when you will file your departure tax, and obviously you have to report the date when you left Canada. That way they will know, and then they will assess if they have paid you excess CCB like after the date of your departure. So you have to return that CCP as well as HST, GST, or any other benefit if they have paid you. So that's something like that's a confusion that they are not supposed to file the tax. So no, you have to file the tax. The other thing is like since everything will be, I'm not selling anything, so I'm not supposed to pay tax on that. No, it's not correct. Like you are supposed to pay tax on deemed sale, as I have explained earlier. So deemed sale mean that on non-registered investment like stock, bonds, crypto, and gold. Yeah, so that's pretty much roughly. These are the things like they must be aware of like before leaving Canada, and we have yeah, that's it.
Is there any special tax return or any special deadlines, Vakar, for these departure when a Canadian leaves Canada they need to be aware of?
So the deadline is same as our regular deadline. So suppose you are leaving. This is 2026. So when we are recording this video, so suppose you are leaving in 2026. So your deadline to file your departure tax is April 30th, 2027. So and there are like in some cases, in fact, like when we have clients on our who are filing departure tax, we have seen most of the cases they have like some penalty form which we will talk about in another upcoming video. So they are not aware of that and they delay, and after April 30th they are penalized, and the CRA actually penalized by sending them a letter of penalty for T1165 and T1135 if somebody has assets over $100,000. So those are the things like you must be aware of, especially with the deadline. So April 30th of a following year is the deadline. So just make sure that you file and file it accurately.
Thank you, Vakar. I still have lots of question about, I'm sure it's more complex than what you're suggesting, that when you deem resident and factual, we're all gonna, and I have lots of question about if I'm running a business, if Canadians are running a business in that situation. And we're gonna cover all those topics in our upcoming videos. But I wanted to thank you for today's time. And I just want you to please summarize in one line about departure tax and to end this video.
So first of all, never ever think that you are not supposed to file the departure tax. You are supposed to. You must file departure tax. In fact, not supposed to. You must file departure tax. And the deadline. Just watch out the deadline. The deadline would be like same as if you are self-employed, then it'll be June 15th for following year. And if you were employed, then it would be April 30th. And if you have penalty forms, as I said, that T1135 or T1161, so must file within the deadline. And there would be a deemed disposition, means that if you have not sold even and you have not pocketed any money, but still you have to pay tax. And there are like some options to defer that tax, which we will talk in our next videos. So these are the things that I want you to watch out when you will leave or plan to leave Canada.
Thank you, Vakar. Our community deserves better.
Thank you so much.